My name is Deborah Roberts, and we are in our first class that we are meeting face to face. Well, we are talking to each other, um, and I just want to say I'm happy that you were able to attend. We'll be meeting twice a week. This presentation that I have before you, we will not get through all of it today. The hope is we'll get through most of it, and then we'll continue on Wednesday. I'm glad you're taking this course, and I'm hoping that this week, the first week of class, was very, very uneventful, other than the fact that we didn't meet via Zoom. You will be meeting in these courses every single week, twice a week, and we're going to talk about what's happening for the week and what we're going to do and any questions. And then I want to use it mostly to help facilitate your start of the week. How do you approach your homework and have any questions that you might have? So the first thing is, what are we going to be doing? This week, in week 2, you should be reading chapters 2. We have a 7-week course, so there's a lot of information, but not overwhelming, I have to tell you. It's going to be quite easy. And I want to make certain, I'm hoping that my video is actually recording. Let's see. Make sure I'm recording. Okay, good. I want to make sure I'm recording because I want to make this available to all staff, all students. So the first week today, we're going to read chapters 2. We're going to be going over some activities like going through the PowerPoint presentation that I have a video of. You will have a discussion and you'll have homework. Homework in Brightspace is going to be called quiz. Don't lose heart. It's only homework, and it's going to be a few questions. So it's not very difficult. It's really just a review to make certain that you understand the topics that we've covered in the chapter and really highlight some areas that you might want to reread. So the homework is really guided homework. Guided reading. It just help you to read the text a little bit more and find more details. In this particular session, we're going to go over chapter 1. We're going to review what we've learned in chapters 1, and we're going to spend a good amount of time on some class activities, problems 1, 2, and 3. If we don't run over, we will start on the lecture for chapter 2. I don't want to rush it because I think chapter 1, we want to go over a couple questions that I've noticed that you are having, but also some activities that kind of reinforces what we've been going through. And before we end on Wednesday, we'll have a lecture for chapter 2, or at least complete chapter 2 lecture, and then we'll talk through a sample problem and then have any questions that you might have. So, chapter 1, what we talked about in chapter 1, I have my textbook here. I'm hoping that all of you had the opportunity to be able to read through chapters 1, and you were able to print it. A lot of times we have a textbook, reading it on the screen is hard for me, so I printed mine. And I want to let you know that you can have your textbook printed at the school for a small fee, if that's what you choose. So in chapter 1, the main emphasis is about making a distinction between managerial accounting and financial accounting. What are the notable differences? Can anybody, using your mic, if you don't mind, if you can tell me one of the many differences between managerial as a review of chapter 1. Can anybody tell me what's the difference between managerial and financial accounting that you've noticed?
Managerial is more internal use in a business, and financial is more outside of a business. Or
therefore, that's correct. And now the next question then is, describe internal. Who would be an internal user of financial information? Anybody want to jump in with that answer?
Would it be like stockholders or shareholders, investors and all?
They are external. They are external to the organization. So for financial and internal, the internal users, the external users. The external users for an organization would be the shareholders, would be banks, would be the government, the federal government and the state government. Those are external users of financial information. And now for the internal users of financial information, can anybody give me an example of who they are?
Would it be the accounting department?
Also, that's one. Anything else? Anyone else who would be interested? Think about if you had a company of your own and you want to have answers to some very specific questions, who would be asking those questions? That would be the first thing. Who's asking questions about?
It would be like
how things-
it would be the CFO and like the board of the directors.
Yes, definitely. Also, when you think about supervisors, division heads, those individuals, HR, and the reason why I use these individuals is because there's nothing wrong with the balance sheet, the statement of cash flows, the income statement, and the changes in stockholders' equity. Those reports are very, very helpful. But if you notice, as you get through the course, you're going to notice that the details that you need, those reports don't give it to you. The details, in fact, managerial accounting drills down in a lot more detail, asking more questions. Should we take this job? If we take this job, would we get more money? Would we have a higher profitability? Analysis like that, albeit the financial statements as a whole are good bits of information, they just don't have the capability of answering those kinds of questions. What's our break even in terms of units? What's our break even in terms of dollars? You can't get that information from a set of financial statements. Now, if I want to see ratios and liquidity, all of that, then obviously the balance sheet and the income statement can give it to me. But managers want far more information, and they need that information to run their organization. So that being said, we are going to be focusing almost primarily on the manager's perspective, what they need to make decisions. So in managerial accounting, why is it important? Because it provides the internal users with practical information that they can use to make day-to-day decisions. It is much, much deeper in terms of detail. It provides more relevant information and more targeted and specific information versus the very high-level information that you'll get from a set of financial statements. And don't misunderstand, financial information in the balance sheet and other statements are very useful, but managers are really looking to know how efficient their operations are. Can they make changes? Should they dissolve or shut down a division? What would be the sensitivity analysis? You know, when you're doing cost benefit analysis, that's not going to be seen at the financial statement level. So that's why I think it's quite important to understand why managerial accounting is different. It is not better than financial. It is different. It has a different role to play. It answers very, very different questions versus the external users of financial information. Like a bank, the bank wants to know your debt to equity ratio. They want to know if you have enough money that you're going to survive. Your solvency is a question that they might be asking. The IRS want to know whether or not your revenue and expenses are legitimate and that they can rely on it when you prepare your tax returns. The state government wants to know also. So those kinds of questions are very useful questions, are very relevant questions for that audience. But when we're looking at us, how can we do our job better? How can we be more efficient within our operations? Are we breaking even? And how can we quantify that to make changes in how we run our organization? Managerial accounting is the best way to get that information. So in chapter 1, we talked about some different terms. Now, for the most part, in a manufactured environment where you're talking about, let's say, company, I'm going to use Apple because I think everybody understands Apple a little bit, or Samsung. Apple isn't a manufacturer of phones and other types of devices like computers, etc. Apple wants to know, they prepare their financial statements, but they want to know also how much money would it take for us to manufacture this iPhone? Why do they want to know how much it costs per phone to manufacture? Can anybody tell me why would they care?
So then they know how much to charge for it, and then
Yes.
in order to make a profit.
Yes, who's speaking?
CJ? Or well, Calvin Ford, but you can call me CJ.
CJ, that's exactly right. But you know what else? They want to know, they want to be able to determine if, now, suppose the iPhone was not invented, and then all of a sudden they're like in the process of R&D, trying to figure out whether or not they're going to create this phone. In R&D, they need to be able to determine the type of cost associated with that product being developed, right? And when they do that, then they can say, okay, if it costs us $50,000 to create 5,000 units, we can assume the price per unit is this much, how much it costs per unit. Per unit cost is very important because that means you can match that cost with your profitability level. Can our costs cover, or the sales price of our product cover our costs and give us the recommended or our projected revenue? And we're going to talk about that in weeks 3 and 4 about how to determine our margin of safety, how do we break even in dollars, how do we do that? So knowing how much something costs in a by unit basis is extremely important. And important to note that you'll never see anything like this on a set of financial statements. You might get a little bit of detail in the notes that accompany the financial statements, but for the most part, how do we come up with our cost allocation? What do we do when we are exceeding our costs? How do we determine what our variable costs are, and how do we allocate our costs? All of that's managerial, which is what we're going to talk about today, or talk about the next 7 weeks. There are going to be some new terms: direct materials, direct labor, and manufacturing overhead. Understand those terms are going to be important. Can anybody tell me, we know what direct materials is going to be easily traceable to our product. In the example of Apple, can anybody give me an example of what a direct material will be? An example of direct materials.
Like the plastic to make the phones.
Absolutely. Now, what about direct labor? In the context of our example, we're talking about Apple creating these computers, the Mac computer, I believe it's called, and their phones. Direct labor, how would you define direct labor?
Would it be like people actually making the phones?
Amen to that. Now let's make it clear. Indirect labor might be an example of a supervisor. Direct labor is going to be the frontline workers, the actual individuals who work with putting the pieces together that create this wonderful phone. I wonder where my phone is. I don't know where it is, but yeah, making a phone. The person that comes together to make this phone. So then the thing we have to think about is when we're in managerial accounting, the terms are going to be a little bit different, not harder. We need to know exactly what is meant by direct materials. This is going to be important. What is meant by direct labor? Let me go back to the previous screen again. See if I can do that. It's not. There we go. What is meant by direct labor? And the reason for that is when we're talking about cost allocation, how we can allocate costs to a product that we're actually making. Remember, the cost of a product includes the materials that's involved, the materials that you use to create that, the people that's involved, but also you have to think about there are other costs that you have to consider, not just the actual device, the manufacturing of it. What about the products? What about the machines that you're using? The machines have to be costed to the price of that particular product. So when we talk about that, we're talking about other costs that are not directly traceable to that product, but are necessary in the production of that product. And that's going to be called our manufacturing overhead. And I provided you with 3 examples of that, which I think is in your text as well. My goal here is to let you know that this is not going to be something that you're going to see once. You're going to see this over and over and over again, so that we want to make sure that we're clear when we define what direct materials is and direct labor, we know what they are and how to identify that, so that when we're allocating costs, and if we're asked the question, allocate these costs, we don't include materials, direct materials in that calculation. And then non-manufacturing costs and period costs. Again, this particular course does have a new terms, but they're actually very, very intuitive. So for our example with Apple, Apple is going to start with raw materials. And the raw materials could be plastic, it could be nuts, it could be a chip that they use to create this device, all of those items. Then you're going to start with the purchase of those materials. And that includes all the costs associated with that. Those two numbers together is going to give us our goods available for sale, so to speak. And then we're going to add to that our indirect materials and our overhead. The flow of costs is going to be from work in process, beginning work in process, completed goods to finished goods. And then once we have finished goods or ending goods inventory, we're going to then send it over to our cost of goods sold. Why? Because we actually sold those products. And this is just giving you a diagram of what work in process looks like. Now, if you use Apple, for example, they may show maybe 3 different work in process accounts, or depending on the product that they have. The main point here is work in process is an asset to the organization. It is work in process inventory, or finished goods inventory, or beginning inventory, all of which will be shown on the balance sheet of their financial statements. So managerial accounting is definitely consistent and works along with financial accounting. We're just going to look at things from a manager's perspective. We have the manager's perspective on the accounting information, which means that we can and often deviate from GAAP. Now, GAAP accounting requires us to record revenue when earned, expenses as incurred, and the whole structure of how financial statements look and appear. Well, in managerial accounting, we can ignore some of those rules. And that's what I like about managerial accounting. I mean, I love the structure of GAAP, but don't get me wrong, every once in a while, it does matter when you're trying to make a decision to have to not be so constrained by the rules of GAAP. In managerial accounting, we do follow GAAP in some respects, but not in everything. And you'll see a lot of flexibility and a lot of differences in how reports look. And if you may have seen a few in your chapter, the income statement may look a little different. And it's not that it's wrong, it's just that the emphasis is not on external, an emphasis on getting information to the managers that you can use and in a way that makes sense to them. So using GAAP is not necessary, and you can see deviations throughout the course. You're going to see how it differs from GAAP accounting and why we do things differently. Managerial accounting can do that. It's okay to do that because we're not preparing any reports for an external user. All of this is for us to make decisions, for our managers to manage and manage their departments. And in chapter 1, we also talked about finished goods and how it all looks, cost of goods sold and all of that. That's not going to change too much in terms of its GAAP side of things versus the managerial accounting side of things. That's another area where there's some similarity that you can recall from previous accounting courses. But at the end of it all, we need to understand what it means and how we can use that information to generate the type of reports or to answer certain types of questions that you'll see in your homework assignments. Now, the income statement, nothing new. Sales minus cost of goods sold gives us our gross profit. And then the reason why we're talking about it like this is because this particular statement is going to be important when we're actually looking at sensitivity analysis. What if scenarios? You can't see that in financial accounting. What if we did this? What if we did that? What if we did this? If we estimate that? And so it becomes important to see how it looks. And we'll be doing some modified, and I won't say modified, but we'll be looking at income statements in a different way, not necessarily how they would appear from a GAAP reporting standpoint. And which is why I'm trying to emphasize it here. I just want to make certain that don't get upset if we deviate a little bit from GAAP, but we can do that. We can do anything we want. We're managerial accountants. We can do anything we want so long as we maintain ethics and honesty in the presentation of information we provide to others. And that's another area that we talked about in the course, using ethics as a tool. It's not just wrong or right. You know, it's all about providing information that will allow our managers and other users to organization so they can make right choices. So ethics is very, very important, a part of that. So our income statement is going to have our gross profit, but it's also going to show our selling expenses and our G&A and our income before taxes. Not all income statements provide this level of detail, FYI. But for our purpose, and when we're analyzing and we're doing sensitivity analysis, it becomes important to see why it's set up this way. So just trust the process, particularly in chapter 1, because we're laying a foundation here. So what I want to do right now, if I can, is give us all an opportunity to work together. I'm going to be working on some problems, and I want you guys to work on together with me. So give me some feedback. Hopefully this will work. We're doing this in technology. Let's see if this works. All right. Now, you can tell me by using your, raise your hand or your audio, can you see the Excel spreadsheet that's in front of you?
Yes.
Good. All
Yeah.
right. Now, I'm going to do exactly what you guys tell me. All right. Now, we're going to work on a couple problems that, now, if you could put on your you don't have to show your face or anything like that, but please unmute yourself because I want this to be engaging. We're going to work on a problem, and I'm going to put on my glasses so I can see here. All right. The problem that we're going to work on is a review of
Excuse me?
chapter 1.
Excuse me.
Yes.
I think I'm gonna get out and then come back in because I can't see the spreadsheet, and I think it's probably my Wi-Fi.
All right.
So
Don't
I'm
think
gonna leave
so.
and come back in, and so hopefully that works.
No,
Okay.
I
don't
can't
think that's
spreadsheet
it.
either.
You can't see it?
We just
Yeah, it's still the
Probably not.
PowerPoint page.
Not a problem. Okay. Now, before you step out, let's do this. I'm going to stop the share. And I'm going to do a new share. Here is it. Share the screen. And let's see. Can you see me now?
Yes.
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 The
Yes.
Excel spreadsheet.
Yes.
Okay, good. Now, this is a review of what we covered, hopefully what we covered in chapter 1. And this is all going to spread to chapters 2, 3, and so forth. So if you get a little stuff, it's okay. We're talking about differential costs, and I think we covered that in your textbook. I want to make sure that we give you a reference point here. Using spreadsheet software. We want to be able to, now this is the organization. They have their financial statements that show here, the annual income statement, their sales revenue of $504,000, their costs, their equipment, their expenses for rent and for supplies, officer salaries, and total other costs. I wanted to take a few minutes for you guys to just to look at this particular data, in addition to the Bayou data, that's the revenue from the new contract, the cost of full-time consultant, and the percentage increase in equipment lease, and the increase in supplies. Now, the first thing I would like for you to do is, as you're looking through this, can you tell me, or can you compute the profit and loss based on, or not including the actual new contract? So what do you think? What should be inside of the sales revenue? Based on the data that's here, what should we put here? Remember, you can take your phones off, your calls off mute if you like, and help me fill out this form. What would be the actual sales revenue without the contract, based on the information? Anybody want to help me?
504,000.
All right. Now the labor, what's going to be? That's correct. What's the labor?
239,400.
Yep. Equipment lease?
35,280.
See, it's not bad. This is not bad. Next is going to be the rent, I believe.
30,240.
All right. Now, before I go any further, the screen that you're looking at, is it big enough for you? I mean, Because right
Yeah.
now, is it big enough?
Yeah.
Yeah.
Okay,
Yeah.
because I can make it
I'm
bigger.
older. I'm older, not me. Okay,
All
that's
right,
great there.
How's that? Is that good? You guys gotta give me
That's good.
feedback.
That's better.
What about the supplies? What's gonna go on that number?
22,680.
And then officer salaries,
147,000.
this is not bad. And then other costs is,
15,960.
right. Now, without the contract, we've got an overall profit of 13,440. Now, what's gonna be our differential cost? Starting with the salaries, what's our differential cost? I'm gonna get my calculator. And remember, we're using all of this. What is differential cost? In this example, the managers want to be able to see what the income statement would look like if they took on the new contract. Being said, what do you think? What's going to be our revenue amount? Our differential cost?
Is it 594,000?
It's the 90,000.
Oh, okay.
And now I'm going to add a column here. It's not part of the question. With contract. Let's see if I can do that. Hold on. All right. That's the 90,000. Let's keep going down. The labor. What about labor? Does that change? It says we have the assumption on the left-hand side of your screen. It says the revenue from the new contract is the 90,000. Do this, and then the full-time consultant is 85,000. The percentage increase in equipment is 5%. The percentage increase in supplies is 10%, and the increase in other costs is 15%. So what should be our new labor, our differential cost for labor?
Would that be the 85,000?
Yes, ma'am. Next, the equipment lease. What's going to be that number?
Hang on 1 second.
Uh-huh.
Is it 4,500?
Let me see. 45. I'm going to get my calculator. How did you get 4,500?
I did 5% of the 90,000.
Anybody come up with a different number? Before I give you the right answer, anybody
I
come up
have
with a
a-
different?
Is it 37,044?
I come up with a different number.
I have
Alright.
37,000. Yeah, 44.
Well, what this number, okay, let's see this. Okay. Now, it says here, there's going to be a percentage increase in equipment lease. When I look at my equipment lease, I'm paying right now $35,280. So I'm going to take that number and multiply it by 0.05. That's going to be my differential cost. The cost of, see, our baseline is how much we pay right now, even before the contract. If we add the contract on, how much we have to pay? We have to pay 5% more, so we're going to up it a little bit. So that 5% increase is going to be my differential cost. Does that make sense so far?
Okay, so we're not finding the actual, like, we're only finding the difference between what the annual income statement and then what the contract is. Okay, I get it now.
The differential cost.
Okay,
Yeah, I added them
okay.
together. Yeah.
I was gonna say I added them together too.
And we will. Actually, I can do that right now, but I want to just emphasize the differential cost. because we're gonna do an analysis once we get all the numbers. What about the rent?
Would that be 0?
Yes. What about supplies?
That 2,268.
Yes. Officer salaries?
Would that be the same?
It's not gonna be, it's gonna be 0. Because
Oh yeah,
there's
it's gonna
no,
be same. Yeah.
that's right, it's gonna be 0. No differential cost because there's no increases. Now, the last one, it says other costs have an increase is 15%. What do you think?
2,394.
Yes. Now, let's look at this for a moment. Now, we can put the numbers here based on contract, and I'm going to do my sum, and then I'm going to copy it all the way down. Oopsie.
Mhm.
All right. That being said, but let's take a look at the differential cost. Now the question is, looking at the differential cost only, the question I'm going to ask right here, and you think about it, and the second question is, why or why not? All right, based on the data, particularly with emphasis in column M, which is the differential cost, should we take the new contract?
No,
What do you-
because it's a loss.
So the answer is, you said no?
Yeah, I said no.
Okay, the answer is right, you're right. We should not take the contract because if you look at the differential cost, we're basically losing money by taking that job. And the nature of managerial accounting, if you were to put this in a set of financial statements, which is this column here, let's look at the column N, compare it with column M. It doesn't look like it's a bad idea to take it because you're not really losing, it doesn't do much. And that's why we have to drill down a little further, because if you were to take the contract on without even asking the question whether or not we can afford it or whether or not we'll increase our profitability, and you create a set of financial statements for this company, and you look at last year's, which is right here, and you look at this year, which is this amount here, you'll say, why is it that our contract, or why is it that our profitability has gone down? This is the kind of problems that organizations don't want to have, ever. They don't want to wait until after you take the job and you're doing the work and you prepare your financial statements to find out that, you know what, you really should have taken that job. That extra $90,000 just isn't worth it to you. It's just not. So managerial accounting allows us to be able to analyze situations like this and make decisions before it becomes an issue of, you know what, we lost money on this. We could afford to lose money. Our profit's already modest as it is. You're talking about $13,000 over a $500,000 organization, and you only bring it back or returning an investment to your shareholders of a little over $13,000. So you're already at a modest position in profitability wise, and then when you add this on, it reduces it even further. So managerial accounting is important for that reason, if nothing else, be able to assess whether or not various projects that you undertake will be advantageous to us. And if they aren't advantageous to us, why not? So the answer is no, we should not take the contract, because it's the profitability decreases. Even if it went up, you could probably, possibly recommend accepting this contract. But profitability decreases, thus changes in equity is negative, and so you're having a negative return on investment. So the answer is no, absolutely right. So when we're talking about differential costs, It's a very, very linear, very straight line. Should we do it, should we not? And can, based on the information we have, does it make sense for us to do it? In this case, it does not make sense. You're losing money, and you're already dealing with a very modest profitability. So the question then is, and this one here I'm going to ask is, what other considerations other than cost are necessary before making this decision? Can anybody think? Let's think about this for a moment before you answer. Now, we're just taking it strictly from the numbers, you know, and many of us are not accountants, so you have a very broader way of looking at things, which is extremely important. Can you think of other things that may be a part of the decision-making process other than the numbers that we just discussed? Anybody want to jump in?
The need for the product or service.
Good. What else?
I think as a company, making sure that you have enough money to afford all of your costs is a big thing to consider. Even though they're not making as much, at least they'll still have enough to afford all of their costs.
Cash flow considerations. Absolutely. What else? Anything else? And again, we're not looking at things from a gap perspective right now. We're thinking if there are other things that we can think about that are not necessarily financial that we would be considering when we look at an opportunity like this. You know, cash flow is very, very important. Take it on, you know, the reduction in profitability goes down, but you also want to think about your cash flow. Do you have the cash to support this? Very important. And the need for profit. You know, the board of directors may say, we want to see our organization grow at a 5% increase. That's enough to say, no, we will have a negative return on investment and will ultimately reduce our growth. So there are other considerations that need to be made. And whether, also the other considerations, does the firm have the manpower to support the job? And that could very well cut into this $85,000 that you have to pay for a full-time consultant. You may not need a full-time consultant. You may very well be able to utilize, I'm just saying, you may very well need to utilize internal staff. And if you can use internal staff, the differential cost, particularly as it relates to labor, could very well go down and change a no to a yes. Any questions on differential costs? Okay, let's try another problem. Let's see. Let's look at this one. This organization is looking to expand. This is the package delivery organization. I'm gonna make this a little bit bigger so that everybody can see, especially these individuals who have, I'm gonna change this format up. There we go, move it up. All right, now I've got it a little bit bigger so that we can see it. I'm gonna make it just a little bit tinier. I just wanna see everything. Let's see. All right, I just wanna make sure we can see it. How's that? Is that good, guys? Everybody can see it?
Yeah, that looks good.
Yep.
All right. Now, package delivery company. We have estimated annual revenues. Let me spread this out a little bit so you can see the whole thing. We have expected annual revenues from our new Express. We have $50,000. We have our total cost to lease vehicles of $7,500. We have a percentage increase in our labor and utilities, 50%, and we have a 20% increase in rent and other costs, So labor and utilities are gonna go up 50%, and rent and other costs are gonna go up by 20%. Here is our annual statement before expansion. Now remember, they use these terms like status quo. The status quo is almost the same as what we said here without contract. So I'm gonna put in here what our status quo is. And our status quo is $152,000, $60,000 for our Vehicle, 48,000 for our utility, labor, 8,000 for utilities, 16,000 for rent, 8,000 for other costs, and the manager's salary is 24,000. So far, so good. Does that make sense, guys?
Yes.
Okay, good. Now, I'm going to do, I didn't want this to pop up like that, but it did. I'm going to take it out. I want you guys to work it through. All right. Now let's talk about the revenue. According to this, the alternative, we're going to put in this column what our, if we were to take this particular annual, this revenue on, what is going to be the change? It's almost like if we include the revenue, this is what, if we include the revenue for this particular job, what would it be? So if we're starting at our 152,000, what's going to be our new revenue if we assume this alternative? Can anybody tell me?
50,000.
If the alternative is going to be our status quo and our current. So it's going to be the 50,000 plus our status quo.
Okay.
Different perspective as opposed to our previous problem. So let's bear with me here. Now, the necessary cost to lease is going to increase by $7,500. So what's going to be our alternative? Uh-oh. Can you guys hear me? Okay.
Yeah.
It's going to be the 60,000 plus our $7,500. Because our alternative is going to be, we're going to add this to our organization. So if this is what we're paying right now, and we're at a loss of $12,000, basically, our alternative is going to give us a total revenue of $202,000. Our vehicle expense is going to go up to $67,000. Our labor is going to go up by 50%. So I'm going to take this number and multiply it by 1.5, or 1.5 plus 50. Give us $72,000 in expenses. What's happening with our labor? Our utilities, same thing. We're going to be paying 50% more. So I'm going to increase my 8,000 by 50%. So our new cost, assuming the alternative, is going to be $12,000. Our rent and our other costs are only going to go up by 20%. So I'm going to take that and multiply it by 120%. And the same thing here, 120%. Two different ways. Let's make sure my numbers work here. I don't like these formulas. They're just way. Very good. I'm gonna copy it. Let's see. All right. Now, the next step is for our manager's salary. That's not going to change. So we're going to put, very good. Now, this takes a different approach here. If you look at the documents or the status quo, we had a loss, an operating loss of $12,000. Now remember, the operating loss does not include general administration or G&A expenses or taxes, which is give us our net profit, net income or loss. Okay, so this number becomes very, very important. We're already losing money, but if we add our alternative to it, our alternative of our package delivery, because they think if we add this to our organization, we'll be better off. The question then is, should we consider the package new express delivery. And then why or why not? Now look at the numbers. We had a loss of $12,000, and remember this is definitely before general administration expenses and income taxes. So that loss is going to be much bigger. If we add the alternative, what do you guys think? We've got increased revenue of $202,000. We've got increased, and again by $50,000. We've got increased labor and utilities and rent and other costs. So in a sense, we're spending $40,000 more for a $50,000 increase in revenue, giving us an overall profit of $9,700. That is the difference, our differential cost. So we're exceeding our costs are extremely controlled. So the question then is, should we take this new opportunity on?
I think we should.
Good. So the answer is yes. Now the question then is, why do you think we should take on this opportunity? And just based on the numbers itself, why should we?
Because we're lessening our loss margin. So we're going from 12 to 2,300.
So we're increasing, I guess we'll say we're increasing our profitability. It adds or increases our profitability. So much so that it reduces the loss, because this on its own, we're losing $12,000. That $9,000 increase, it almost completely eliminates the loss, almost. You see that? That $9,000 almost absorbed a $12,000 loss. So the organization is better off doing that. So this particular, and this change, this expansion is actually positive for the organization and offers potential for growth. Very good.
Professor, I have a question on this.
Mm-hmm.
Why would your rent increase? Because if you have the same building, wouldn't that be the same cost?
In reality, yeah. In this example, no.
Oh, okay.
Let's be real about it, though. In reality, when you're taking, this is called the express services. I would think, if you look at this, I would think that the cost of vehicles would be much higher. And the labor would be, I would think the labor would be higher too, because again, you got to have a person that's going and doing the delivery. So that makes sense. But the rent, I don't know. Why would the rent go up? You know, other costs I could probably deal with the other costs going up, but I can't explain why the rent would go up.
Yeah, I just thought that would be a fixed cost that wouldn't
And
change.
it really is. The thing, and that's a good point. Fixed costs and other costs. Fixed, variable, and mixed. That's going to be the good prelude to our next chapter. But I would agree, unless they're looking to have more space to do the work, it's not clear in this particular example. But in reality, you know, one of the things that makes expansion better is there are some costs that you don't have to worry about touching, because you already have the facility in place, you already have the staffing in place. You may have to pay a little bit in overtime, that kind of thing. So a lot of that remains constant. Those fixed costs generally remain constant, and you're going to see more constant costs. You know, the fixed costs staying the same, and the variable costs going up and down. This example is not necessarily true to that, because I would suspect the rent would stay the same. It would add to the value of taking on this new job, if you will. So yeah, I think for this example, yeah, it doesn't make sense. But in reality, most people, the rent is not going to change because you're locked into it. You know, rent is usually a 1 year, 2 year, 3 year type of thing. You're locked into it. So I don't see why the rent would go up. But for the sake of this example, however, despite the fact that the rent did go up, this organization would do well to take it on. It not only provides them with a profit, but the profit is high enough to absorb the losses in the previous loss. So very, 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 very positive. So yes, I totally agree with that assessment. All right, I'm going to stop the share here and go back to sharing my PowerPoint presentation. Again, let's go back to that. Let me know if you can't see my PowerPoint. All right, so we did our problems. Now, the next one is going to be on the screen. And again, this problem is really just to get you thinking about the manufacturing and the manufacturing and merchandising firms and how they're different and how to utilize the information. Sometimes the terminology might be the same. So for the manufacturing company, cost of goods manufactured on the right-hand side, which one of the terms that you see through 1 and 4 are applicable? Would you see the cost of goods manufactured? How does it relate to a merchandise firm? Does it relate to a merchandise firm? What do you think? Is it merchandise inventory? Is it the same as used for a merchandising company? Is it net purchases or not applicable?
Would it be the same used in the merchandising company?
So number 2?
Yes.
Actually, cost of goods manufactured is exclusive to a company that builds and makes something. So I think, anybody have a different answer before I go any further? Okay, I think the answer is number 4, not applicable. They are different. The cost of goods manufactured does not apply to the merchandising firm. Now, let's talk about what is a merchandising firm. Can anybody tell me, an example of a merchandising firm before I give you a definition? What is a merchandising firm? We already know what a manufacturer is. Apple is one, General Motors is one, Samsung is another. They build something. They take something from scratch and they build it to a product that they ultimately sell. What's a merchandising firm?
Wouldn't that be something, places like Target?
Absolutely.
Okay.
They are like wholesalers in many ways because they buy it already in place. For example, a merchandising firm like Walmart or Target will buy from a manufacturer like Samsung. Because if you go to Target, I'm trying to think. No, you don't go to Target, but maybe if you go to, trying to think where we get a cell phone from. You could go to Walmart and get a cell phone. I'm almost certain.
Best Buy?
That's it. There you go. Best Buy is a good example. A merchandising firm. They buy from the Fitbits of the world. They buy from the Samsungs. They buy from the Apples of the world, and they buy from the IBMs and any other kind of product. So that's what makes them different. They have cost of goods, but not cost of goods manufactured. So if the answer to the first one, cost of goods manufactured, that's going to be number 4. It's going to be 4, not applicable. What about work in progress inventory? Does that translate to a merchandising firm? I'm not trying to trick you. I would say no. Remember, a merchandising firm products that they resell are already finished. They're already at the place of they're able to sell. They don't have to do any processing to them at all. And most often they don't even have to package them. They're already packaged. Sometimes they might have to package. It really depends. So the work in process inventory does not necessarily apply to a merchandising firm. A merchandising firm would use terms like purchases inventory, merchandise inventory, that sort of thing. What about finished goods inventory? A manufacturing firm has their work in process. Well, first of all, they'll have their raw materials, right? And then they start to work on them. So they move it from raw materials to work in process. Once they get the process complete, they move it from work in process to finished goods, in which they sell it and they take it from out of finished goods and they move it to cost of goods sold. So finished goods only applies to a manufacturing organization. So again, not applicable to a merchandising firm. But cost of goods sold, what about that one? Does that apply to both or one or the other?
Both.
It does. The answer would be number 2. Same term is used by a merchandising company. Cost of goods sold is used both at the manufacturer level as well as the merchandise level. And this whole activity is just to get you to see how these two different types of organizational structures are, how they're different. And then some similarities. Because when we're going through this course, we're going to be kind of flip-flopping between the two, using both, mostly heavily on the manufacturing side, but again, in some cases, the merchandising and sales. Job costing is one area where you're going to see that lot of demarcation. Job costing, process costing, which one applies to a merchandising firm, which one applies to a manufacturing firm. We won't get into that today, but I do want to make certain that you, as you're reading through the chapters, the differences between a financial accounting is going to be important versus managerial, the difference between a manufacturing organization and a merchandising company, the type of questions, the type of terminology, and so forth. Very good. All right. Any questions so far? Any questions about chapter 1? Chapter 1 is a pretty straightforward chapter. Doesn't have much going on, but just make certain that we're gonna, if you feel like a term doesn't make sense or you need to go over it, chapter 1 is a very, very good foundation chapter. You might need it as a reference when you're going through the other 5 chapters of this text. Chapter 2 is going to talk about cost behavior. Now, before we talk about cost behavior, I want to first of all mention, we talked about direct materials, direct labor, et cetera, et cetera, et cetera. What we want to make sure that we talk about now is how does a cost behave? What is a cost to begin with? What is it in the first place? So chapter 2, which is what we're going to talk about today, I'm going to go back and see if I can share my screen. Yes, I'm going to share so that we can talk about this. I see something in the chat right now. Let me look at it. Oh, okay, good. Very good. All right, so let me talk about chapter 2. Cost behavior. Now, cost behavior is important to note in this chapter, but we want to first talk about different terms that are applicable. Fixed costs, variable costs, mixed costs, direct materials, direct labor, manufacturing overhead. You're going to find these terms follow you all the way through. So I want to first take a minute to define what they are and put them in perspective within the managerial context. A fixed cost remains the same no matter how much activity is going on. It doesn't change at all. Can anybody think of a fixed, we've already mentioned one fixed cost, but give me another example of a fixed cost. Can anybody tell me? You can interject with your phone, with your, take your phone off the mute and answer that. What is an example of a fixed cost other than the one we mentioned earlier? Doesn't change at all. Any examples of a fixed cost?
Salaries.
Say again?
Salaries.
Yes. Salaries. And also rent, which we talked about. That's a one. And depreciation is a fixed cost. Very, very good. So a cost that does not change in response to volume. Does not change. It does not change at all. You can do 100 units. You still got to pay the salaries to your employees. You can do only 1 unit. You still have to pay salaries. It does not change at all. Variable costs. Variable costs, the definition that's in the textbook is a cost that is responsive to changes in volume or production. So variable costs are going to change in the same direction. So that means that the more you produce, the higher your costs are going to go. The less you produce, the less your costs are going to cost you. So variable costs are going to be changing in proportion to the volume, and most often direct proportion to your volume. Fixed cost does not change in terms of your volume. Now we have also another little monkey wrench to throw in here, is that is mixed cost. Mixed costs are going to have a component, and remember, this is going to be important in chapter 3. We talk about that. Yes, it's going to be very important in chapter 3. But a mixed cost has a combination of both a fixed portion and a variable portion. And we're going to talk about that later on in the chapter. But for now, know the difference. Fixed costs do not change with volume. Variable costs does change with volume. And here is a graph of how it shows. You'll see it on one side, on the left-hand side, you see the variable costs. And then on the bottom, you see the units. And as units are increasing proportionately, I'm going to see my, you can see my mouse here. But as you continue to change in volume, you see the cost proportionately goes up. So that's all it's saying. When you're dealing with variable costs, and that's really how you're going to be able to tell whether or not a cost is variable or fixed. If the projection goes up and you see a change in the cost, you know that cost is variable. And if you see the cost stays the same no matter what happens, you know it's fixed. And let's see if we have a copy of that on. Here's a fixed cost. It's a horizontal line when compared with volume. It does not change at all. And I'm moving slowly on this because you're going to find that fixed costs, variable costs, and mixed costs are going to be very important considerations when you're doing sensitivity analysis. Also, when you're trying to calculate break even or margin of safety, it's going to be important to know the difference among those different terms. Mixed costs are partially fixed and partially variable. Now, don't worry about all of these details right now. Just understand what a fixed cost is, what a variable cost is, and what mixed costs are. Just get an idea of that. The formula that you note down here, y is equal to mx plus b, it's really about the slope of a line. That's all it is. Don't worry about that yet. We just want you to, first of all, focus your attention on the relationship between costs that are fixed and the costs that are variable and how they are represented on a graph. What happens? Because when we would talk about how costs behave, managers want to be able to say, if I manipulate these variable costs a little bit, how would it affect the output? As you know, fixed cost doesn't change, so we can't really do anything with fixed costs. We can't change them. Rent is going to be rent. Salaries that we pay to our employees are going to be salaries. It's not going to change. So the only real true test of how well an organization can efficiently use their resources is how they control those variable costs and go up and down like this. So fixed costs, we can't do much with it. Actually, unless you eliminate it completely, there's nothing you can do about fixed costs. It is what it is. It's the variable cost that's going to make a difference, and it's going to be the variable cost that we're going to be doing a lot of analysis on, because we're going to be trying to figure out if it's the right choice to make. If we're actually can we increase our profitability? How do we increase our profitability? We need to know what our margin of safety is. Where's our margin of safety at? A little bit number over our break even, where we are safe. Or our break even is where we don't make any money or we don't lose any money. So knowing that is going to be important, and mixed costs or variable costs are going to be a big, big, big deal. And we need to understand how they move and why they move and what makes them move the way they do and how to interpret that movement is going to be important as we consider. So when we think about those kind of costs, discretionary costs or fixed costs, short-term versus long-term, again, in managerial accounting, there are some very, very cost-benefit analysis that needs to be done. We can't just say the numbers on their face. We can't just say, this is the numbers, this is what we're going to do. There are other considerations to be made when a decision needs to, that we need to make a decision, which is why the question I've asked you is, what other things you think about? What other things do you need to think about as opposed to just the numbers? That becomes important. So limitations, understand the limitations, and consider those in the decision. Because again, we are managers. and we have to make an informed choice, but we're going to be held responsible for that choice. So that means we're going to really think about all the pros and cons of it and know the limitations of all of that. So what am I leading to? How do we estimate costs? How do we predict what costs would be given a certain set of circumstances or a certain set of assumptions? Estimating costs. Account analysis is one way to do it, and just looking at the transactions and how they relate to one another and predicting based on your account balances. That's one way. Statistically, you can use regression, and we're going to use that. We're going to work on that, I think, in our Wednesday class. I'm going to do a regression analysis just so you can look at it. And we can use a scatter graph. And I'm going to do a scatter graph and I'll do a high-low. Knowing what these different methods are, advantages of them, disadvantages of them, and knowing when to use each one. That's going to be our topic for Wednesday's conversation. But how do we estimate costs? We can use the high-low method. We can use the scatter graph method. And we can use a regression, which is a very sophisticated statistical tool. And I am not going to ask any of you to learn how to use a regression within Excel. I'm going to demonstrate it. I'm going to teach you how to use it, but I am not expecting anybody to know how to do a regression. This is statistics, and it is not this course. Okay, so do not lose heart. Everything that we do with regression, I'm going to show you exactly what I need you to know and how and what these numbers mean. I am not going to ask you to do a regression. That's just way beyond the scope. Okay. The scatter graph is not that bad, but it is using Excel and using the graph function in Excel. And you may not know how to do that, but I, again, will be demonstrating how to use it and how to interpret it. I don't expect anybody in the class to be able to, I'm going to ask you to do a scatter graph. No, no. The high-low method, again, using paper and pen, we can do it without a hitch. So I will again demonstrate that. Now, with that being said, chapter 2 is about contribution margin. Well, income statement, we don't have a contribution margin. Well, in managerial accounting, you do. And again, this is all about us being able to have the flexibility to be able to deviate from GAAP as much as we can to answer some very specific type of questions depending on who's asking the question. But here, on this particular spreadsheet here, or this PowerPoint, is just laying them side by side. I would say you can remember sales minus cost of goods sold gives your gross profit, minus your expenses gives your operating income. Boom. But we are not going to be using that per se. We're going to be not much. We're going to be using the contribution margin and knowing what that is. So let's take a minute to look at this one side. We're going to be looking at the right-hand side of this PowerPoint slide. You'll see that a contribution margin income statement contains the following. It has its sales, which is the same on both sides, but then you see here is different. What is this? Variable costs. Now, a contribution margin can be done in dollars and in units. And I think you might have an example of that in your textbook. If not, I'm going to show you a little bit later. Contribution margin in dollars, contribution margin in units. Either way, it's going to be your sales minus your variable cost equal your contribution margin. And why do I say in dollars and in units? And the reason for that is because you're going to need that information when you're actually calculating the break even. And we know a break even is when you do not lose money and you do not have a profit. So it's going to be zero. The contribution margin is going to be zero. There's no profit at all. So that being said, make note, contribution margin equals sales minus our variable costs. Then from that contribution margin, we're going to subtract out our fixed costs. And in here, it talks about period and product costs. Period costs are costs that have already been incurred. And the period cost would be, I would think an example would probably be depreciation. That would be a period cost. Product costs and period costs. That would give us our operating income. So when we're doing this contribution margin, note the differences between the two. The sales number looks the same, but here, instead of having cost of goods sold, which is on the GAAP side of things, right? Generally, it's the accounting principles. You got to have your cost of goods sold, get your gross profit. Well, gross profit equates, in this case, to our contribution margin. So our sales, which is S, minus our VC, which is our variable cost, equals our CM. Subtract our FC, which is fixed cost, equals our operating income, which is OI. Now, before I go any further, has anybody read chapter 2 yet? We're only on Monday, so I'm not really sure. You can comment. Did you read your chapter 2 yet?
No.
Yes? Okay, that's good.
No.
That's good. That's okay. No. That's good. That's good. That's good. Because I want to lay the foundation for chapter 2. So I've got my book in front of me. I think there's something else here that I want to talk about. Let's see, short-term versus long-term, development range. All right, good. So this should help. When we're predicting costs, we have to be very important to note that the fixed cost is not going to be changing unless we eliminate the cost completely. And we will have some scenarios in, I think, week 5 and 6 that we will be able to remove the fixed component of certain items, because if we're trying to do something, we remove them. But in general, though, when we're predicting costs, we're going to be very much concerned with variable costs. Very concerned. And in fact, that's going to be the emphasis. So we're going to have to make certain that we know what a variable cost is, and we know what, when compared with a fixed cost, is important, because a lot of calculations, not a lot of them, but a lot of calculations will hinge on that knowledge. So what's fixed cost? It's linear. It doesn't change regardless of the amount of production. And we're, again, in the manufacturing perspective. This is all in the manufacturing perspective and not in the merchandising perspective, okay? So fixed cost, doesn't matter how much the volume changes, the fixed cost is going to remain same and level. Rent is one example of that. Number 2, assuming linear, we're going to have to assume the cost is going to be the same per unit. And again, these are major assumptions and imposes its own set of limitations, but let's just assume some certain things. Let's let it have a standard of things. This is assumptions that we're going to be keeping in mind as we're going through this analysis. Separate costs from our separate variable from fixed is very important. And also variable cost is going to be pretty much linear. And we're most certainly going to have extraordinarily more control over variable costs as opposed to fixed costs, because of the level of commitment fixed costs have. Just the way it is. So a lot of control over variable costs, which is mainly in the real world where all the cost cutting happens. You can't change your rent. You're in a lease agreement over 3 years. There's nothing you can do about it. But you can control the volume of activity and how much it costs per unit. That you can control. So again, we're going to be emphasizing a lot of our decisions will be on the amazing part of variable costs and how we can manipulate those up and down to achieve our objectives. And here is an example of what it looks like using the slope that we talked about a little bit, using a regression analysis. Don't worry about this. I'm going to go into a good amount of detail in an example in our next class. Just read through this chapter and understand it is one way to predict what our cost would be like given a set of circumstances. All we want to do is predict costs, and variable cost is key to it because we can't control fixed costs. So our total cost, TC, is equal to our fixed cost, FC, versus our variable cost, VC. And our variable cost is going to be units by the amount of volume. What we're doing is we want to analyze how costs behave when we move things around, when we change our number of units that we're going to produce, when we change the level of fixed costs. We want to be able to see how costs are changing and how we can make different decisions based on our estimates of what the cost would be. Our cost would be. So we're again using estimates here. Let's see. I think that's the end of my presentation. So that being said, hopefully, can everybody see me here?
Yes.
Okay.
Yes.
No, the reason why I keep asking is because I've been having some connection intermittent issues, and I just want to be careful. So what I suggest for you, all of you, by Wednesday, at the very least, try to at least just read through the chapter in its entirety and take some notes. What we're going to be doing in the future on Wednesday is we're going to dig into examples. I think we're going to have about 5 problems, maybe more if time permits. 5 problems that go through each one of these different things we talked about today. How to determine what a fixed cost is versus a variable cost. How to calculate our contribution margin by unit and in dollars. We're going to talk about how to utilize the high-low method in predicting costs. How to use the regression to predict costs. So it will become important for you guys to read through that entire chapter. So at least when I'm going over the items with you, you can engage and answer questions. I mean, you may not be able to answer all the questions I pose, but you can answer some. So we're going to be doing that. So read the chapter for me. That would be great. The other thing that I want to go over in this chapter, I think, is that y equals, I'm going to share my screen once more. And go to this, just so you can look at it. Now, looking at this particular, we talked about fixed, variable, and mixed. We're going to be using the high-low method. And I want you to remember, this is going to be our slope, which is going to be y is equal to mx plus b, or in this case, our variable costs is equal to our bx plus f. And now the reason why I did that is because I want you to be able to always see the comparisons and parallels. The first equation is definitely algebraic, that you've learned in how do we create the slope, how deep the slope of a line is. I'm going to compare it with how do we use it for purposes of determining our slope in our variable cost equation. So remember that. That would be something I would like you to emphasize in your reading so that we can do a demonstration on how to plug in the numbers that represent each one of these. What's the F, what's the B, what's the X, etc. So don't worry about it right now, but as you're reading through, I want you to pay close attention to that. And I think that is on pages number, let me think, 112 of your text. From page 112, actually, it might even go even further than that. Let's see. Very good. Yes, go from 109 through 113. Very important parts of your reading. And we're going to do an example of that. That's the only part of this whole entire chapter that I think might be a little bit more complicated, which is why I'm isolating with you guys. So if you could pay particular attention to pages 109 to 113. The other parts of the chapter are fairly straightforward. The high-low method is pretty straightforward, and the scatter graph is pretty straightforward. I just want you to emphasize this page because it might be a little bit more challenging. So make sure you read the chapter in entirety, but emphasize 112, 109, and 113. It makes this, I'm just giving you a heads up because that's going to be the hardest part of this entire chapter. Everything else in this chapter is extremely straightforward, extremely easy to grasp. The pages 109 to 113 might require a lot more work, and we're going to do a demonstration. We're going to do a demonstration of the high-low method and the scatter plot, which is the Excel spreadsheet, and the regression. But the regression is going to be important to understand in light of pages 109 to 113. I hope that makes sense. But if you read the chapter, I think you will agree with me that that piece is going to be a little bit more challenging for you. So this week, your duties will be to read chapter 2. By Thursday, if you can, no later than Friday, if you can, respond to the discussion topic. Now, I'm going to stop the share here and go into the classroom. I just want to show you something in the classroom. Give me a second. I want to just give you guys a good foundation for the week. All right, now I'm going to share my screen again. Just give me a second. And I'm going to share the classroom. All right, here is our class. Let me know if you can't see. I'm going to wait a second to hear from you. Hopefully you can see it.
I can see it.
Good. All right, here's our classroom. All right, now, everybody has their own way of navigating the course, but I just want to give you some ideas of how the course is structured a little bit. Here is where you start your syllabus. Here are the activities you can access, and let me know if you can. You should be able to access all of the modules, regardless of what day or time it is. That means you can always go back to module 1 and go through some of the topics there, and you can even go forward in module 2 and 3 and 4. These are just learning activities. And what I've tried to put in them is just some PowerPoint presentations so you can look at and refer to, and also videos that you can look at your own leisure. Also, when you go back to the browser, you can do the same thing. Let me go back to the beginning of class. Just so you can use it. You can access all of your materials here as well through content, through discussions here, but you can also access it here where it says discussions are going to be here, your homework here, and your ethics or your paper and your exam items are here. Either way, you have 2 ways of accessing it. It's a matter of personal preference. It makes no difference to me so long as you can get to the information you need to do your work. So for this week, we have a discussion topic, and I'm going to highlight that. Utilize your Q&A if you have any questions, or email me for personal questions that you might have. We talked about managerial costs and all of that. Our discussion for today, or this time, is going to be on cost behavior. What is a cost equation? And if a company has fixed costs of 1,000 and variable costs of 4 per unit, what is their cost equation? And what should a company use as a cost? What should the company use the cost equation for? This question really does depend on you reading the chapter first, but again, interact with your peers and answer that question. If someone doesn't understand, or if you don't understand, we're here to work together and learn as a group. So my hope with the discussions is that it further requires you to go through your textbook, read a little bit more to grasp a particular concept that I really want to emphasize. And the cost equation, which is what we talked about a little while ago, is something that I think is important to talk about. So that's where your discussions are. How you access it is up to you. But by Friday, hopefully you'll be able to have the answers to those questions, and I will jump in as needed to keep the conversation going. So that's your discussions. In this course, you'll have your quizzes, and the quizzes are not really quizzes, they're just homework. And what I try to do with the homework is really just to get you to think about things a little bit, to use your textbook a little bit more, to see if there are some areas where you need to read a little bit or you may not understand, and to prompt you for questions. If you have a question, you can ask that of me, of course. So you'll see your homework questions for each chapter. And the quizzes are generally open during the week, but I've kept chapter 1 open just because I like to see, I just want to make certain that people get acclimated to the class, and I give them a little bit more time to do the first chapter. But in the future, we will be a little bit more strict on terms of due dates. But for now, just get used to the format of the class and do your homework as quickly as you possibly can and ask questions. That would most certainly help me guide what I say in these meetings. I want to be able to address your concerns and your needs. But here are the quizzes. They are not necessarily quizzes, they're more homework. But I can't change the terminology in Brightspace, so don't worry about that. What else is in this chapter? So read through the chapter. If you have an opportunity to download the PowerPoint, by all means use it as a guide, particularly for chapters 2 and 3, where there's a lot of computations that you'll notice, a lot of them. None of them are hard, it's just a lot. And then if you want to look at the videos that I've recorded, by all means do so. And finally, discussion and homework. So you read chapter 2. I don't know why I said chapter 3 here. It should be chapter 2, but you read chapters 2, you do your homework, and you answer the discussion topic, reply to as many individuals as possible, a minimum of 1, but more conversation, the better for everybody. So I'm never discouraging interacting with your classmates. More than 1 person is always good. And that is it for this week. So chapter 2, read a chapter, complete the discussion, attempt your homework, and you should have more than 1 opportunity. I think you have 2 tries for your homework. The best grade always works. And on Wednesday, we're going to be spending most of our time doing problems. I just want you guys to be familiar with the type of problems that you'll need to understand as we progress. So less lecture, more problem solving. So if you read the chapter, it would do very, very well with this particular lecture, with Wednesday's class. I really need you to read the chapter because I don't want to be talking to myself. I want to be talking to all of you. So I want you guys to be engaged. Any questions? I'm going to stop my share here.
I do have a question.
Okay.
Will your PowerPoints be available for us? Like in addition to the videos, will your PowerPoints be available?
Yes, ma'am. And what I'll do is I will put it in the announcement page. You know what I mean? The announcement side. So you don't have to go find it. You have to drill down and look. It's going to be right there in the announcement page, and you can pull it and use it, print it if you like, or just use it as a reference.
Okay, thank you.
And I'm also going to attach also the Excel spreadsheet that we worked on today. I'm going to attach that as well. So you'll get the PowerPoint presentation, you'll get the Excel worksheet that we worked on today, and the recording.
Okay, thank you.
All right.
And
We
like the
are
open-ended
done. If you don't have any
portions of the
questions,
quizzes and stuff.
do you have a question?
The open-ended portions of our quizzes, does that get graded at a later time?
Yes. The bright space does not grade the manual one. So I will go in and grade. I will most certainly have it done before Saturday, but I do manually grade.
That was going to be my question.
Yep.
Okay.
Anything else?
I know this is early, but regarding the midterm and final, like how they look, will they be proctored or like multiple choice? How do you know how that'll be set up?
No proctoring. No, you need your text. So it's going to be multiple choice. There'll be some short answer. The number of questions, can't remember. I think is about 50. I think the final will be 50 questions. I think the midterm will be between 25 and 50 questions. Multiple choice mostly. You might see 1 or 2 questions that are short answer. Try not to make it complicated. Everything that you see within your homework is kind of replicated in some way in the midterm and the final exam.
Okay, gotcha.
No proctoring, no proctoring. And there is a time limit there is no time limit, actually. There is no time limit. So my hope is that you can't get out and come back in. That's the only problem. You have to do it in one sitting, unfortunately. Does that answer your question?
Yes.
Okay.
Yes, thank you.
Okay. All right. Well, if there are no more questions, I'm going to stop the recording right now.